All right, let's talk about the building blocks of managerial accounting. Some of the basic concepts that will form the foundation for all the things we'll talk about in managerial accounting. First off, we're going to say there are three basic kinds of companies: service companies, merchandising companies, and manufacturing companies. Service companies simply provide a service such as healthcare or consulting. Their income statement is going to be the single step: revenue minus expenses to give us net income. And on their balance sheet, if they're a pure service company, they're going to have very little, if any, inventory because they're not selling things. A merchandising company sells things. They buy things from a manufacturer or a wholesaler and sell them for more than what they paid for them. And that markup, that difference between what they paid for it and what they sold it for, that's called gross profit. And gross profit divided by sales price is gross profit margin. The merchandising company's income statement is going to look like the multi-step format: sales minus cost of goods sold gives us gross profit, minus operating expenses gives us operating income. And on their balance sheet, they will have inventory, stuff they bought that they plan to sell to their customers for more than what they paid. The third type of company is a manufacturing company. They're going to take raw materials and turn them into something else and then sell them to merchandising companies for more than what it costs them to manufacture them. So their income statement is going to look like sales minus cost of goods sold gives us gross profit, minus operating expenses gives us operating income. And on their balance sheet, they're going to have three different kinds of inventory: stuff they're going to work on, stuff they're working on, and stuff they're finished working on, and they're just waiting to sell. And one company could be a service company and a merchandising company, or a company like Amazon. There's an argument that they are all three types of companies. From time to time, we'll talk about the value chain. That's a series of tasks or processes that result in a happy, satisfied customer. We want everything along the value chain to be a value-added activity. For example, if I have a lot of extra inventory in my distribution system, that doesn't add any value from the customer's point of view. As long as they get the product that they want, they're happy. So having extra inventory is an extra cost in the value chain. That's not good for us or good for our customer. And perhaps the best way to talk about cost objects and direct costs and indirect costs is to look at a manufacturer. First, we'll separate our product costs from our period costs. Product costs are any costs that are incurred within the factory, like direct materials, stuff that's easily traceable. Direct labor, labor costs that are directly traceable to the product that we're working on. And manufacturing overhead, indirect materials, indirect labor, and other indirect costs. Indirect materials are small things that it's not worth us keeping track of. Little tiny nails, we're not going to keep track of how many little tiny nails went into each of our dining room tables, let's say. Indirect labor, it's impossible to say how much of the quality control person's salary and health benefits went into each table. So we'll park those in manufacturing overhead and apply them with a manufacturing overhead application rate. And period costs are all the expenses and costs outside of the factory. Selling expenses, so our wages and our commissions that we pay to our selling personnel. Administrative expenses, the president's salary, the treasurer's salary, the health benefits to all the corporate headquarters personnel. Those are period costs and not part of our manufacturing costs. All right, so we've got let's say we're making dining room tables. Then our cost object is our dining room table. We want to know how much it costs us to make that dining room table, so we know that we have to sell it for more than that to make a profit. The first thing we did was we separated our product costs, stuff inside the factory, from our period costs, stuff incurred outside the factory. Well, what do we do with the product costs then? We're going to trace those product costs through these T accounts. We're going to take materials, labor, and overhead, move it into work in process. Think of that as our factory floor. We're going to work on it, and then we're going to finish it and store it in our finished goods warehouse. Once it gets to the finished goods warehouse, no more costs accrue to it, and then eventually we sell it, and hopefully we sell it for more than what it costs us to make. And so that dining room table that we're making, that's our cost object. Our direct costs are our labor, our materials, and our labor. And our indirect cost is our overhead. We can easily track materials and labor. Tracking overhead's not so easy, so indirect costs will have to be applied with a rule. We're also going to call labor and overhead conversion costs. That'll come up when we talk about process costing, which says instead of costing our stuff by job, maybe we look at each process each month. So labor and overhead are called conversion costs because we apply them to materials and convert them into something else. And we should talk about cost behavior. Fixed costs don't vary in proportion to sales. So if I have an airline and I own my own airplanes and I record depreciation expense on those airplanes on a straight line basis, it doesn't matter how many miles I fly, it doesn't matter what my sales are, that depreciation is still going to be, let's say, 1/20th of my cost of my planes every year. And it may change. Fixed costs change. It doesn't mean they're unchangeable, but they don't vary in proportion to sales. Variable costs do vary in proportion to sales. For example, if I have an airline and I sell more tickets, then I fly more miles, and then my fuel costs go up. Finally, there's such thing as a mixed cost. It's got a fixed component and a variable component. Suppose I pay the Oakland airport $10,000 a year for the right to land my planes at the airport, and every time I dock at one of their gates, I pay them, say, $500. So in that case, it's obvious that the $10,000 is the fixed, and the rest is variable depending on how many times I dock at the gate. But in the real world, it isn't always that obvious, and we'll either use the high-low method, we'll look at the highest and lowest point, to make a guess at the fixed portion and the variable portion, or we'll use a regression analysis in Excel to draw this line for us so we can make a good guess at the fixed versus the variable. If we're a manufacturer, our raw materials cost is variable. The more stuff we make, the more raw materials we use. Our labor is generally considered to be a variable cost. The more stuff we make, the more labor costs we have. But the odd thing about overhead is that there's a fixed and a variable portion. So, for example, think of our rent on our factory. No matter how many units we make, that rent is fixed. Think about the lacquer that we put on our tables when we manufacture them. That's a variable overhead cost. The more tables we make, the more lacquer we use. And so later on, we'll talk about maybe we should treat that fixed overhead a little bit differently because we're going to incur it no matter what. Finally, we might want to talk about controllable versus non-uncontrollable costs. Imagine you're the manager of a local Safeway store. You have no control over your rent that you pay for your store. So when we evaluate your performance, it would not be fair to consider uncontrollable costs in whatever matrix we use to evaluate your performance. And we want to distinguish between relevant and irrelevant costs. We're talking about when we're making a business decision. So I'm trying to decide whether I should fly to LA or drive to LA. Well, the money I spent on my car insurance last month is not relevant. First of all, it's a sunk cost, so there's nothing I can do about it. And my car insurance is a bill I got to pay whether I fly or drive to LA, so it's not relevant. However, the price of gasoline is relevant. If I fly, I don't have to fill up my tank to drive to LA. If I drive, I am going to have to fill it up. So that cost is subject to change. So it's going to be part of our decision-making process.